Ladies and gentlemen, good day and welcome to Jubilant Ingrevia Limited earnings conference call for the fourth quarter and financial year ended March 31st, 2023. As a reminder, all participant lines will be in the listen-only mode, and anyone who wishes to ask a question may enter star and one on their touchtone phone. To remove yourself from the question queue, you may enter star and two. Should you need assistance during the conference call, please signal an operator by pressing stars and 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Pavleen Taneja, Director, Investor Relations, Jubilant Ingrevia Limited. Thank you, and over to you, sir.
Thank you, Tanvi. Good evening, everyone. Thank you for being with us on our Quarter 4 and Financial Year 2023 earnings conference call of Jubilant Ingrevia Limited. I would like to remind you that some of the statements made on the call today could be forward-looking in nature, and a detailed disclaimer in this regard has been included in the press release and results presentation that has been shared on the website. On the call today, we have Mr. Shyam Bhartia, Chairman, Mr. Hari Bhartia, Co-Chairman, Mr. Rajesh Srivastava, CEO and Managing Director, Mr. Prakash Chandra Bisht, CFO, Jubilant Ingrevia Limited, and Mr. Arvind Chukhani, Group CFO, Jubilant Bhartia Group. I now invite Mr. Shyam Bhartia to share his comments.
Thank you, Pavleen. A very good evening to everyone. Thank you for joining us on Q4 and Financial Year 2023 earnings conference call of Jubilant Ingrevia Limited. We are happy to announce that during the year FY23, our specialty chemicals business grew 29%. Chemical intermediate business placed highest ever volume of acetic anhydride and gained higher market share globally. However, nutrition business have faced headwinds for niacinamide, leading to lower volume as well as lower price realization. EBITDA in FY23 was lower mainly on account of higher energy prices and challenging market situation of niacinamide business. During the quarter, though our specialty chemical business recorded a higher revenue and chemical intermediate business have placed higher volumes of acetic anhydride year on year. However, overall revenue was lower due to price of acetic acid, leading to lower price of acetic anhydride and headwinds we continue to face in niacinamide business. Though EBITDA during the quarter for chemical intermediate business improved year on year, however, overall EBITDA performance impacted due to challenging market situation of niacinamide and some of our specialty products meant for agrochemical customers. We firmly believe that challenges faced in niacinamide business in some of the products in our specialty chemical meant for agrochemicals are of short-term nature, and business is confident to regain volumes, revenue and profitability as market situation improves. Our endeavors towards growth plans remains undeterred through our structured growth capex, and we are confident that driving robust growth in future. This growth will be led primarily through our specialty chemicals and nutrition business segment. We are also glad to share that the board has recommended a final dividend of 250%, that is 2.5 per equity share of the face value of rupees 1 each for FY23. This shall result in cash outflow of rupees 39.8 crores. During the year, company has already declared an interim dividend of 250%, that is 2.5 per equity share of rupees 1 each, and the total dividend for FY23 works out to be 500%, that is rupees 5 per equity share of rupees 1 each, amounting to 79.6 crores of cash outflow. With this now, I hand over to Rajesh to discuss about the business in detail.
Thank you, Mr. Bhartia. Very good evening to all of you.
At the outset, let me welcome you all for joining us today for Q4 and FY23 investor call of Jubilant Ingrevia Limited. I sincerely hope that you and your loved ones are keeping very well. Let me now take you through the financial and operational performance of Jubilant Ingrevia Limited for the fourth quarter and financial year 2023. For the year FY23, our revenue was lower over last year, mainly due to lower price of acetic acid, leading to lower price realization of both acetic anhydride and ethyl acetate, and due to headwinds we faced in niacinamide business. While our specialty chemical business revenue maintained healthy growth of 29%, we have also been successful to improve our market share of acetic anhydride by placing significantly higher volume over last year. Overall, in FY23, our EBITDA was lower, mainly due to high energy costs, including coal prices, lower performance of niacinamide, and normalization of acetic anhydride market situation as compared to last year. Revenue during the quarter was lower on year-on-year basis due to lower price of acetic acid, leading to lower sales price realization of acetic anhydride and ethyl acetate, and lower demand of niacinamide, leading to lower volume as well as lower price realization. EBITDA during the quarter was down on year-on-year basis, mainly due to lower performance of niacinamide and the headwind faced in specialty chemical business, mainly from agrochemical customers. However, chemical intermediate segment EBITDA improved on year-on-year basis due to better price realization of acetic anhydride. We have started witnessing improvement in demand of niacinamide, while we expect improvement in demand of agrochemical customer to normalize by end of Q2 FY24. On the energy cost front, we have arrested the increase in cost to great extent, supported by lower coal prices as well as improving operational efficiencies both in generation as well as in consumption. Further, our plans to reduce overall energy cost by sourcing power at Gajraula from grid, which will start by end of Q2, and from renewable sources, which will materialize during next financial year, are on the track. Now let me take you through the updates on all our three business segments. Specialty chemicals. Our specialty chemical business during FY23 has recorded revenue growth of 29% over last year, mainly due to higher volume sales of both existing as well as new products. However, EBITDA for the year was lower over last year, mainly due to higher energy costs during the year and lower demand of agrochemical customer during H2. During the quarter, revenue of specialty chemical was lower year-on-year basis, and EBITDA for the quarter was lower year-on-year basis, mainly due to lower demand from agrochemical customers, leading to significant drop in price realization of some of our products meant for agrochemical end use. We continue to see positive traction in demand of our CDMO products. In view of this, during construction of our new GMP facility, we have taken a conscious decision to upgrade the capacity, which though have delayed our GMP plant, however, will benefit us in longer term. We have commissioned both our CGMP plant in Bharuch and non-GMP plant in Gajraula now. Our new CGMP multipurpose plant in Bharuch will help us to facilitate our global pharmaceutical clients' new drug development program and will position Jubilant Ingrevia Limited as a leading partner of choice to innovators within regulated markets. Our multi-purpose non-GMP plant at Gajraula will further aid us to structurally shift more towards value-added specialty chemical business. This multi-purpose product facility has been engineered to handle multi-step complex chemistries and will expand company's foray into value-added derivatives of both pyridine and non-pyridine based products. Nutrition and health solution. Our nutrition business has recorded 28% lower revenue during FY23 over last year, and EBITDA was impacted significantly, mainly due to severe headwinds we have faced during the year due to avian and swine flu in US and EU regions, leading to lower volume and significant price erosion of niacinamide. During the quarter, revenue of nutrition business were also lower year-on-year. However, sequentially volume has started improving, while price remained under stress during the quarter. Business has started witnessing the improvement in demand as well as improvement in price of niacinamide in the present quarter. As mentioned by Mr. Bhatia, we firmly believe that the challenges faced in this segment are of short-term in nature and business is confident to regain volumes and revenue and profitability along with improvement in market situation. Our efforts towards increasing our presence of niacinamide in food and cosmetic end-use segment is yielding positive results, and in view of this, we have approved the capex to build new CGMP-compliant facility which will produce about 3,000 tons per annum cosmetic grade of niacinamide. This capacity will be ready during the quarter April to June 2024. In addition, our development work on bringing up new CGMP-compliant facility for food-grade vitamin B4 is going on track. We expect to approve this capex sometime during July to September quarter this year. Both the above initiatives will reduce our high dependency on global feed market and will provide consistency to our nutrition business. Chemical intermediates. Our chemical intermediate business has recorded lower revenue during FY23 over last year, mainly due to lower prices of acetic acid, leading to lower price realization of acetic anhydride and ethyl acetate. We continue enhancing our market share of acetic anhydride both in domestic as well as international market. Chemical intermediate business EBITDA for FY23 was lower than last year, mainly due to normalization of prices, which was better during last year due to better market situation of acetic anhydride. During the quarter, revenue of chemical intermediate was lower year-on-year basis, mainly driven by lower price of acetic acid, leading to lower price realization of finished products. EBITDA during the quarter was higher on year-on-year basis due to higher volumes. Overall outlook of acetic anhydride market appears to be stable, with global demand continues to grow in several end-use segments. During the quarter, we have been successful in bringing new customers for acetic anhydride, mainly in Europe region, which will ensure good utilization of newly added capacity of acetic anhydride. We would continue rationalizing our sales of ethyl acetate and specialty ethanol to niche customers only to optimize our margins. Other financial details. The company was under the old tax regime during FY23 and the ETR is 29.6%. Net debt of 31st March was rupees 312 crore and net debt to EBITDA ratio was at 0.54 times on the basis of trailing 12 months EBITDA. The net working capital percentage and number of days of working capital for Q4 FY23 on the basis of trailing 12 months turnover were at 17% and 62 days respectively. The capital expenditure during quarter was rupees 146 crore and for FY23 was approximately rupees 481 crore. Outlook and growth capex plan. The specialty chemical business, though we expect short-term impact in demand from agrochemical customers for some of our specialty chemical products, and we expect demand to normalize during H2 this year. Our niacinamide business is already witnessing improvement in global demand, and accordingly we see price is also moving up. Our next new capex plan is going on track, and we continue to focus on improving our revenue mix from specialty and nutrition business segment. And with this, I would like to conclude our opening remark. We will now be happy to address any question that you may have. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Harsh Shah from Dimensional Securities. Please go ahead.
Hi, good afternoon, sir. Sir, first question is on specialty chemical division. So the price reduction which we have seen, is it more related to demand slowdown or have you also seen additional supply come into the market? And what would be the inventory situation right now?
So in specialty chemical, the agrochemical customers' demand was under pressure. So therefore, we saw the price realization was lower. And also some of the products like pyridine, the prices have been under pressure. Therefore, the performance of specialty chemical was lower than last year and last quarter.
By how much percentage have the realization been impacted?
Very difficult to give you exact percentage, but yes, there has been significant reduction in price realization. Because difficult to give you product-wise.
No, maybe on a blanket basis in both chemical intermediate as well as specialty chemicals.
No, chemical intermediate, the price realization has been as per the acetic acid prices. So there has not been any deterioration of price. Our margins also have been good. So chemical intermediate, there was no challenge.
Okay. And do we continue to hold any inventory in our book which was bought at a higher price that still needs to, get sold and whose impact is yet to be recognized in the books?
No. We are not carrying. So this performance is not because we are carrying high inventory. This performance was because globally agrochemical demand was lower. So other suppliers have been supplying at much lower price to liquidate their material. But this is not the case for us. We are not carrying any extra inventory.
Okay. And sir, what would be the volume growth for Q4 and also for full financial year FY23 across all three segments?
Volume growth in terms of chemical intermediate, we have grown to the extent of 7 to 8%. In specialty chemical, in Q4, our volume has been almost flat. We have not grown. In nutrition business, as you know, our volumes have degrown from last year. But sequentially from Q3, we have grown our volume in niacinamide.
Okay. And so there has been increase in the other expenses. Could you explain what could that be?
So the increase in the other expenses primarily over last year is on account of this year's higher freight expenses, the higher warehousing charges, and higher processing charges. Over the last quarter, the increase is mainly the above three factors, which is freight, warehousing charges, and processing charges. In addition to that, higher consumption of stores and spares. So these were the reasons for which
they are in general in nature. They are mostly in general in nature.
These are general expenses.
And just last question. So since the realization of many of our products, key products have come down, be it nutrition or specialty chemical and even chemical intermediaries, so aren't changing our guidance of revenues because the guidance which we have given, the prices of all these products are much higher than what they are now. So do we stick to the same revenue guidance or do we want to trim that down in terms of absolute number revenue of the incremental capex?
No. So if you see, there is no fundamental change which is happening. This is, as Mr. Bharti also said, I also said, both these, what is happening in market is short-term in nature. This is not going to last long. We are already seeing improvement in niacinamide market situation, and we are very hopeful that H2, even agrochemical market should start improving. So I don't think we are doing any change in our guidance for capex.
No, not the capex, but the revenue that you'll be generating from this capex. There is a guiding or doubling of the revenue. So with the prices coming off.
There is no change much. There is no much change because we have given you guidance based on what realistically we will do. We have not given guidance which is very hypothetical. It's more realistic guidance we have given.
All right. Thank you so much. I'll join the queue.
Thank you. The next question is from the line of Naushad Chaudhary from Aditya Birla. Please go ahead.
Hi, thanks. Two clarifications. Firstly, in specialty business, what percentage of revenue comes from AgChem and is entirely from the generic AgChem, or do we work on any innovative molecules here in specialty?
So AgChem is contributing to almost 37 to 38% of our specialty chemical revenue, and these are mostly the value-added derivatives which we supply to large agrochemical companies. We are not supplying any innovative molecules.
Okay, and in terms of the margin and EBIT run rate this used to generate 60-70 crores, that has come down to around 40. Do you believe next 2 quarters is difficult to guide on this, or do you think this could be a bottom and sequentially you should see an improvement at least on the EBIT side in this division?
I can fairly assume this is the bottom we are touching. We have to have improvement from here. May not be immediately, but as I said, from H2 will be definitely coming back to the normal situation.
And what all things should have to happen for the improvement from here on? Would that be from the price or would it from the raw material side? What should help from here on to improve this profitability?
If the demand improves in agrochemical, our products are very well suited. Customer will buy, and of course we will sell the product as we have been doing it earlier.
And
the fundamentals are same.
Okay, and these all are specialty largely are spot business, or do we work on a contractual terms?
No, so we do, as we explained earlier also, we always have the annual volume confirmation of the customers, and we discuss the volume dispatches every quarter. So we know we have the visibility of volume, but if the market situation changes, the customer can change his volume in between also. So we know clearly what volume is asking during the year.
Okay, so in specialty, see, there is an operating deleverage challenge, but are you also experiencing the pricing pressure as well?
Yes, because the demand is lower, of course the pricing pressure is there.
Okay, understood. And you expect this to improve from second half of this?
Yes, yes.
Okay. All right, all the best. Thank you so much.
Thank you.
Thank you. The next question is from the line of Siddharth Karekar from Equirus Capital. Please go ahead.
Hi, sir. Good evening. So first on specialty chemicals, we had just highlighted that our volumes were flat YOY in specialty chemicals. And if I look at the revenue numbers, they have increased 5% YOY. So what am I missing here in terms of, is that a realization decline, volume decline, or what explains the margin profile in this quarter?
So, sometimes this revenue also depends on the product mix which you sell during the quarter, right? So it's difficult to say that. So what we said that, yes, the revenue has increased, but volume has been flat. So, it is because of product mix. We have almost 40 products to sell. So depending on which product mix, sometime it happens.
So secondly, in terms of agrochemicals, can you just point out which products actually have seen that slowdown that has impacted our performance?
So agrochemical, pyridine and some pyridine derivatives, because we have mainly pyridine derivatives which we are selling to agrochemical customers.
No, the end agrochemicals, if you could highlight which are the agrochemicals which have seen them.
Yeah, the biggest one is paraquat, diaquat, which is produced out of pyridine, and there are many host of products where we supply.
Okay, got it. So, and lastly, in terms of our capex, we have removed the capex slide from the presentation. Is there a change in our capex guidance or anything?
No, actually, for so many quarters we have been just repeating the same picture. So, and that we did because we formed a new company. We wanted much better communication. But I now don't want to confuse you guys. But there is no change in our guidance, as I said earlier. It's just that we made our presentation much more cleaner. But of course, if there is any clarification question like you are asking, there is no change in capex.
So what should be the capex for FY24 and 25 then?
So 24, 25 or 23, 24?
FY24 and FY25 for the next 2 years.
Okay, FY24, FY25. So FY24, I think we have a guidance of almost 700 crore cash outflow, and FY25 should be close to 600, as we said earlier, if you see our earlier presentation.
Okay, so got it. Thank you.
Thank you.
Thank you. The next question is from the line of Janice Chheda from Spark Investment Advisors. Please go ahead.
Good evening, sir.
Good evening.
My question is more to do with the power cost, which has gone up substantially if I compare from FY21 and FY22. And also there is a jump in the other expenses. So can you help us understand how the power costs are likely to move in coming 2 to 3 years, and how will it impact the profitability?
So if you see the quarter 4, our energy costs are close to normal situation. Of course, little higher, but it used to be very high in Q1, Q2, Q3. But we have arrested it, as I said. One is that coal prices have come down. Secondly, we have done a lot of efficiency improvement, and also if you see our consumption profile in efficiency improvement, we have improved. So I think there is not much now in terms of very high cost of power and fuel, but of course we are working further to optimize our energy cost. But yes, FY22 has been very high, as you have seen that.
Yeah. So on a steady state basis, what will be the power cost as a percentage of sales or some other ratio that you can help us with?
Again, percentage becomes very difficult because in our case, sometimes revenue becomes difficult to explain because of raw material prices. But on an average, if you see last year, we have been close to 18% of our revenue on our energy cost. So that percentage keeps changing. Right now, I think in Q4 it is close to about 23%. That's what I said, that maybe little bit more improvement will be close to our normal situation.
Okay. And in terms of the nutrition business, what is your outlook for FY24 and for FY24 and for next 5 years and for next 3 years as well?
So for 3 years it is very difficult to confirm, but I can only tell you that in nutrition business, the situation we can see today is improving both in terms of price as well as demand. So we are happy to say that, of course, this quarter we will have lag, but by end of this quarter, our situation is coming much, much better than what we have been earlier.
Okay. Because your previous margins are around 20% EBITDA in nutrition business, which has collapsed. So what will be a sustainable number is what we are trying to understand.
I think we hope that H2 we should be in a position to catch up.
Okay. Thank you so much, sir.
Thank you. The next question is from the line of Rohit Sinha from Sunidhi Securities. Please go ahead.
Hello. Yeah, thank you for taking my question, sir. One is that how we are seeing this Chinese market before and after the reopening of economy, which all we are talking about, and how it is now influencing our business segment.
I missed your point. You are asking about Chinese market?
Yeah. How the Chinese market are actually influencing our business, and how especially mainly it has influenced before and after the opening of this economy.
So we have been saying that few products, like niacinamide or maybe some base product of pyridine, where we have some competition from China, and of course, if China gets aggressive, we get impacted. But most of our other products like CDMO and other specialty derivatives, there is hardly any competition we face. And in chemical intermediate, there is no competition from China. So I don't think there is much impact in these businesses. But some products like niacinamide, we have competition in China. Pyridine, we have competition in China. So we see if China becomes aggressive, then of course we see the impact in price reduction.
Okay. So any change we have seen in last few months, especially, already we are seeing this kind of pressure in pyridine and niacinamide. So any improvement as of now, or still it is the same situation?
Yes. So niacinamide, I have already said that improvements are happening now. Niacinamide, we can clearly see the improvement both in demand as well as pricing. And China has really come out of material, so obviously situations are improving.
Okay. And sir, one thing that what are the factors or measures which should help us in sustaining the margin in specialty chemical, despite the volatility in the acetic acid prices or raw material. Let the price be up or down, but we should at least manage to hold somewhere average margin in the segment. Or it may be again the question that we are looking at absolute EBITDA growth or EBITDA margin improvement in that segment.
No, specialty chemical is not that situation. You can say chemical intermediate, I can agree with you that depending on acetic acid, our margin percentage may vary. But yes, in chemical intermediate, we continue to see our EBITDA improvements because of volume growth. Coming back to specialty chemicals, we have more or less stable margins in most of the product. But sometimes when the market situation like we have now, which is not only for us, it is for the global, there, then it becomes difficult to hold the prices and we have to compete with the market. And that time we have to really see our margins going down. But in specialty, it doesn't happen that raw material prices goes up, so our margin will go down.
No, just because this quarter obviously we are taking a different kind of pressure, but that is where I was indicating that it should not be coming again going forward, as I think we were also saying that this should be a bottom out kind of situation for Okay. And one last question, if I can squeeze in power costs, as earlier participant was also indicating that how we are placed going forward. So as we are seeing that on quarter we are improving on power costs. So how we are now placed with coal dependency, and are we still looking the opportunity for renewable sources? I mean, putting up our plant and or looking for sourcing the renewable.
Overall coal prices have come down, as you know. So overall cost has come down. But in Gajraula, we see some positive results in terms of our contract volume supplies. Some volumes have started coming, so that is why you see improvement. Coming back to further improvement, as we have said in our speech also, in Gajraula, now we are also going to get connectivity of grid. So of course our power cost will further reduce. And also we are working on sourcing the renewable energy, which is solar and wind combined. That something will happen after a year or so, maybe 1.5 years. So that we are not committing for this year, but yes, we are working, which will long term give us the benefit starting next year onwards. But currently, I think situation is very much in control, both because the overall market price of coal has come down and government has eased a little bit of supplies of contracted coal in Gajraula.
Okay. Thank you, and best of luck.
Thank you.
Thank you. The next question is from the line of Nitesh Dhoot from Prabhudas Lilladher. Please go ahead.
No, hi team. Thank you for this opportunity. So my first question is on the specialty chemicals on the CDMO side. So we had a couple of contracts totaling 270 crores that was to be executed over a 3-year period. How much are we targeting to execute in FY24 from this contract? And if you can provide a revenue guidance for CDMO facilities overall for FY24.
So that contract which we had informed you is happening as contract volume. There is no change. Of course, what happens in these customers, sometimes the volumes you dispatch in one quarter and then second quarter the volumes does not go. So quarter and quarter may vary, but on an annual basis, whatever we have, customer has asked for is happening. There is no change.
Okay, so any number that you can ascribe, for the CDMO revenue potential, at an optimum utilization, any number that we can work with?
So earlier also we have said that the new GMP facility which we have just commissioned is going to add up the revenue in our CDMO business, and that revenue it will normalize coming up in the H2 of this year because plant is picking up in capacity, and of course H2 onwards our CDMO revenue also will go up.
Okay. And so where have we reached on our diketene derivatives plant utilization? And if we are maintaining our 70% utilization guidance for FY24 there?
Yes, we are very close to 65% of our utilization. We are hoping that it will continue to improve in going quarter.
Okay. So on the chemical intermediate side, where would we be on the capacity utilization of the CI segment for Q4 and for FY23 as a whole? And I mean separately for acetic anhydride and ethyl acetate if possible.
On acetic anhydride, other than this new plant which we have just commissioned, I think we are operating at 85 to 90% capacity, and that is the reason we brought this new capacity. And this quarter, I mean the current quarter will be our first quarter where the new capacity will be sold, and of course we have a plan to slowly gear up on volume gradually. So we have a plan in next 1.5 to 2 years to use this entire capacity, which is about 50,000 tons. So quarter on quarter we will have improved volumes from this capacity.
So in a couple of years' time, you are looking at a full utilization there.
Yeah, we always say that, but you know, it also depends on demand. Like in last plant, we said that this will take 2 to 3 years, but fortunately because of market condition, within a year we could utilize the capacity. So you never know. We always give a guidance which we can definitely do it. So yes, in couple of years we will be in a position to utilize this capacity.
Okay, so have we already seen a base EBITDA number for the segment at 59-60 crores, with the pricing and the spreads normalization that has happened for the older capacity, or do we expect further spread compression coming up?
Unless there is a very severe market headwinds we face, I don't think there will be change in this base profile. You know, you never know in commodities, something very drastically happens, you don't know, but in normal situation, I think we should be seeing similar level or better because our volumes are going to be better.
Sure. So one question on the management change. Mr. Anil Khubchandani's exit, at a time when the company is in the middle of executing a large capex, especially on the specialty chemical side. So anything to read into this, or if you can give some color on this?
I don't think there is much to read about it. I mean, it's a market where he found his next inning better somewhere else. He decided to move on. Of course, it's not a good situation for us, but we have our succession pipeline so strong. The people, our structure is such that the below we have all the business heads who are taking business. Anil was responsible for his specialty chemical business, which is consisting of 3 or 4 smaller business units. Those business unit heads are already at place. They are taking care of their business. I am already there, and there is now a new head for a leadership point of view. So I don't think there is anything to be read more in this. But yes, anybody leaves the company, there is a situation where we don't feel good about it. But I think as from business continuity point of view, I don't see any challenge as of now.
Okay, sir. So one last question, if you can just squeeze in before I come back in the queue. So how are we confident of the impact on the specialty chemical side? And when we say that this is a one-off 1 quarter impact, because if I draw a parallel from what we experienced over the last year or so, and what we initially perceived to be a short-term impact in case of nutrition segment, or in case of the coal issues on the specialty chemical side. So I mean, how are we so confident that that this challenge will go away in a quarter's time?
No, so we are also looking at the market. You are also looking at market. I am also reading that agrochemical market situation should improve in H2, If you read anywhere, any company in terms of agrochemical performance, everybody is saying that H1 is going to be tough, H2 has to improve, and that's how we can envisage. I don't think I am saying anything new.
Okay, sir.
Sorry to interrupt here. I would request you to please come back in the queue. A request to all the participants, please limit your questions to 2 per participant so that the management is able to cover all the questions from the participants in the queue. The next question is from the line of Dhruv Mochela from HDFC Mutual Fund. Please go ahead.
Hi, sir. Thank you so much. So, question similar to the earlier ones. On the spec chem, for the last 2 years, a decent part of the growth in spec chem was driven by agro. I get data from your presentation. Your agro ag chem revenues, where specialty revenues have moved from about 300 crores to about 700 crores in the last 2 years, FY21 to 23. And now that we are hearing all about China recovering back, normalizing and all those things, our revenue growth was also coinciding a lot with the disruption which has happened globally. So I'm just trying to understand, is there something which was, some kind of one-off benefits that one should be aware of when it's thinking about the growth in future?
So I don't think we had if you see the regularly for last 7-8 quarters, our performance of a specialty chemical has been improving both in pharma and agro. And this time in this quarter, we have seen a very, very poor demand from agrochemical customers, and therefore there is a performance gap. But I don't see that this is something which is changing our regular performance of a specialty chemical business.
See, we just to add that we hear from our customers that from H2 the demand will be normal, and that is why we feel that the customers whom we are supplying the material, their excess stock of agrochemicals lying with them because of lower demand of agrochemicals in Brazil and US. Therefore, they feel that this excess production which they have with them will be used by North America and Brazil and Europe. So therefore, we strongly believe that listening to our customers that from H2 the demand should be normal.
Got it. So I was just trying to dissect it because there is a lot of news flow that China is now back to normal versus what it was in the last 2-3 years. So this is not because of China recovering. This is more because
this is not because of China.
Yeah.
This is not because of China, because our agrochemical companies in US and Europe, they have surplus production lying with them of the finished agrochemicals because of lower demand of agrochemicals in Brazil and in US mainly and in Europe. Therefore, as soon as they are going to their stock levels will come down, they will start buying them. What we hear from our customers, there's nothing to do with Chinese.
Got it. Perfect. That makes sense. Yeah. So the second thing is on pyridines. Now, based on a basic understanding, pyridines also find a lot of application in some of the newer molecules. Probably, you might not directly be linked to it, but indirectly your products might go or some other competitors' products might be going, pyridine products might be going. So I'm just trying to understand your earlier comment that pyridines are, your products or pyridine products are largely into generics. Just wanted to get some better understanding there because...
No.
Yeah.
See, the pyridine products are used in various uses, and including the new uses of these products are in electronic products, like even in the electronic circuit board also it is being used. So I'm just saying that it is a new uses of product is coming in, but the demand increase is about 3 to 4% only. But new users are coming, which is a higher value pricing, but of course the total demand is growing only at 3 to 4%.
In case of pyridine, if you see that all the new product development which we are doing, we are taking care of many industries. So there are a lot of derivatives which you are planning, and every year we are launching 4 or 5 new derivatives. So pyridine, for us, we say pyridine, but there are almost 35-40 products which we regularly sell, which are used for pharma, agro, electronics, personal care, all those uses.
And just as a comment, I'm telling you that in pyridine, 40% of pyridine is used internally by us.
Yeah.
So it is important for you to understand that we are also making intermediates. New intermediate means new captive consumption goes up. So we are adding value. Our objective is to add value to pyridine in next 3 or 4 steps and then meet the requirement rather than selling pyridine.
Sure, sir, got it. So that is a bit of question. If you have a lot of inter-segment consumption, ideally that should have knocked off in the inter-segment revenue reporting, but that does not happen. Probably I'll take that offline.
Right, but pyridine-based intermediates which are used in agrochemicals, the demand for this was less. So our sale was less. So now that demand will become normal, then our sale will go up.
Yeah. So the second question is on the capex for FY24. You mentioned 700 crores. I believe large part of your announced the capex that you had earlier in the presentation mentioned is committed capex. Large part is done in the end of FY23 or probably commissioned in early FY21 to FY24. So what is this capex now for 700 crores? If you can probably mention the key projects.
Okay, so if you see our last presentation, the key capexes are this non-GMP multi-purpose which is going on. We have expansion of our vitamin B3 into cosmetic grade which is now going on. We have plans to approve vitamin B4 food grade capex. Then we have plans to add one more GMP facility. All that what we have said earlier in our last presentation is still prevailing, and we have said 700 crore this year is still prevailing. So there is nothing changed. If you see last year, last presentation, you will find everything.
Okay, because a lot of these projects were not to be committed, so probably they have converted to committed now, is it?
Yeah. Of course. So quarter on quarter, we keep taking decisions on those capexes which are ready with design, development, everything. So it takes time. First you develop product, then you pilot it, then you design it, then you take a call of capex approval. So of course, we take it gradually, not all together.
Sure.
Quarter on quarter, we will take this.
And the last question on the food grade acetic acid. It's about a year now. So how is the ramp up? I think in the last call you mentioned it takes a year or so to get the approvals and done. So it's almost a year now.
Food grade acetic acid very much on place. We have a good product, quality product, GMP plant being audited by customer now, and volumes are picking up slowly. So of course this is a product which is low volume, low pack size, going to food customer. We can't expect a large tanker load, but it is picking up very well. So it will pick up. Of course, it will take little time to gear up in the customer segments to catch up the volume. But very well done in terms of facility being audited by customer. So we are well placed. It's doing well.
Sure, sir. Thank you so much and all the best. Thanks, sir.
Thank you.
Thank you. The next question is from the line of Rahul Veera from Abacus Asset Managers. Please go ahead.
Hi, sir. Good evening. So given the plants that are coming online and the OPEX is where the demand for the segment is only going to improve in H2, what is the probability for the overall console EBITDA to degrow next year?
Next year means FY25?
Yeah, 23 over 24.
Oh, 24 over 23.
Yeah.
So we are confident that the EBITDA of 2024 will be better than 23.
Okay. And what is the operating cost coming from on the new plant, sir, at the OPEX level? And if they are working at 10-15% utilization, given the demand scenario, I believe there will be a large cost that will come in the OPEX, sir.
Not all plants are 10 to 15% operating. Most of the plants we start with full operation. Of course, during the year the volumes will start picking up. But once you start the plant, you have to start full plant. We can't operate.
I can only tell you that our CGMP facility and also non-CGMP facility, from H2 it will be 100% utilized. 100% means about 85% will be utilized.
Okay. And given the current prices of the specialty chemicals, even at 85% will it break even?
No, CGMP this will be a CDMO.
CGMP is mostly pharma, so it's not agro basically.
Okay. And for pharma, the demand is still maintained?
Yeah, it's still there.
So, CGMP is pharma and non-CGMP is also agro and
pharma.
To some extent of pharma also. But demand for agrochemicals from H2 is going to be normalized. So from H2, all our plants are going to be used by at least 85%. Because that is why we put up plants, because there is a demand for our products. And we are confident that we will use 85% of the capacity.
So I'm just trying to understand, like if we take the sequential EBITDA degrowth from Q2 to Q3 to Q4, it's almost been like a 50 crore degrowth.
But that sequential EBITDA degrowth is not only specialty chemical. If you see nutraceutical, we have significantly drop in EBITDA. That is the major issue. That is improving now. So you will see overall performance going to be better.
Right. But so overall, if you see, continue the same argument again, given the current prices of pyridines or even the OPEX that will come from the new plants, your EBITDA, in my view, even if there is a offsetting factor of power savings or offsetting factor of niacinamide improvement on the nutrition segment, there should be a EBITDA degrowth.
No, see, our performance on specialty chemicals from H2, it is going to be totally normal. Plus, new plants will add to the additional sales that will give us leverage rather than deleverage. So, firstly. Secondly, on chemical intermediates, because of our new acetic anhydride plant starting, our overall sales will be better. Now, on niacinamide, we have already told you that we expect the situation in Q1 has improved substantially. The Q2 we expect to be better, and going forward we expect the situation to be normal as we used to operate normally. Last year was a very unusual situation.
Sure.
Especially in H2, if you see, it was very, very low. H1 last year was also reasonably okay in niacinamide.
Sure. So just one last question from my end. I wanted to understand what will be the incremental depreciation or interest cost that will come for FY24?
So it will be in the range of 20 to 25 crores on depreciation.
Okay.
And about interest will be in the range of 15 to 20 crores.
Incremental?
Yes.
Okay. Fair point, sir. Thank you.
Thank you. The next question is from the line of Tarang Agarwal from Old Bridge Capital. Please go ahead.
Hi, good evening. Couple of questions from me. If I were to look at your nutrition business, what will be the indicators which you think will help this business move up? I mean, last 1 year we've seen a significant compression in this business because of market dynamics. So what are you seeing now which is leading you to believe that Q1 situation is improved and it should consecutively move up?
So see, last year there was two factors. One is the avian flu in Europe and the avian flu in US. So if you see, this avian flu reduced the total requirement of this thing, and supply was more, so the prices also went down. But now the avian flu effect is gone, and now the situation is normal, and we strongly believe, and we are seeing in the market today, both the volumes and the price going up. What we are telling you, what we are seeing in this quarter. So we expect the H2 performance is likely to be good in niacinamide, both on volumes and price. What we are telling you that we are seeing that is not that we expect.
Sure.
That's what we have stated that.
Got it. And sir, given how this market has been under pressure last 1 year, are there significant inventories that are there?
No. So So as Mr. Bhatia said, that in the beginning it was the impact of flu for 2-3 quarters, but then last 1.5 quarters we have been facing the liquidation of inventory. So therefore the prices were under pressure. But now the inventory is almost gone, it's normalized, and then only we are seeing the market situation coming up. So there is no inventory in the pipeline.
Got it. So second question is basically, if I look at your specialty chemicals and chemical intermediates business, the indexation of both these businesses to pharma is reducing. I mean, percentage of revenues coming from pharma for both spec-chem and chemical intermediates, that's successively gone down. So I understand agrochemicals grown, but is there any specific development in the pharma segment that you all are seeing, which is?
So let me tell you both. First, we start with chemical intermediate. Chemical intermediate, pharma mainly is paracetamol and ibuprofen. In that market, we have a very strong market share. And whatever market growth is happening, we are also growing. Now, in chemical intermediate business, in acetic anhydride, there are multiple uses where the growths are happening. Like, for example, in agrochemical is only one part of it. There are other products which are also growing. So obviously, where the market will grow, we will also grow. So there is nothing wrong happening in pharma. It is just because the other end uses are growing better. Obviously, our volumes will also grow better. And the same is happening in specialty chemical. There is not bad or something going down. In fact, in pharma, we are adding capacity, as you know. We have added GMP. We are going to add capacity in GMP. So as much we will add capacity in pharma, we will have the growth in revenue from pharma also. And at the same time, there is a growth happening in agro also. So there is no fundamental change which is happening. If the demand is going little higher in agro, we will do there equally better.
Thank you. We'll take the last question for the day, which is from the line of Siddharth Karikar from Equirus Capital. Please go ahead.
Yeah. So just on the food grade acetic acid, so how do we look at the utilization for FY24 and FY25?
FY24, we see that we will be in a position to utilize approximately 50% of the plant.
Okay. Yeah. So secondly, in our specialty chemical again, now what we are looking in the market is that this quarter will be a peak restocking quarter, where even domestic agrochemical companies have lowered their production. So is it fair to assume that the revenue contribution from specialty chemicals in first quarter will be lower versus last year, or how should we look at it? So even our profitability will be lower in the first quarter?
So you see, we expect the demand to pick up slowly and will get normal by the H2. So the total, it's not that total demand is not there. Total demand is less than the normal demand that we were getting from our customers, mainly international customers. So I think what we hear from them, what we hear from our customers, that demand will, of course, gradually go up, but ultimately it will become normal in H2.
No, just specifically from the next quarter, given that we are almost 45 days into the first quarter, so we would be having a fair sense of how things are, because what I understand is that the entire margin deterioration or the volume decline that has happened would have happened after 15th or 20th Feb. That is where we had seen that impact in the global market. So now, given that we are 45 days into the quarter, is it fair to assume that even first quarter would be on similar lines, or it would be better than this or worse than this?
Yeah, first quarter also is in the similar line so far, but we still have half of the quarter.
Okay, sir. Okay.
So far we are seeing the same situation, yes.
Okay. Thank you.
Thank you. As this was the last question for today, I would now like to hand the conference over to Mr. Pavleen Taneja for closing comments.
We thank you all for joining this call today. We hope we have been able to answer your queries. For further clarification, I would request you to contact me. And thank you once again for your interest in Jubilant Ingrevia Limited.
Thank you. Ladies and gentlemen, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.